Hello and welcome to another episode of the Investor Financing Podcast. And I'm your host, Beau. And on today's show, this is a series, the Lender Showcase, because you guys asked to get more bankers interviewed on our channel. So that's what we're doing. We're diving deep with bankers throughout the nation, and we're going to talk about banking and credit unions and the differences on lending appetite. So I wanted to kind of dive deep on all these topics that I know that our listeners and viewers are going to look for. And today we have a very special guest, Chris Schlaffman, right? Did I say it right? Schlaffman.
Correct. Yes.
Okay, Schlaffman. I always want to pronounce it right. He's the VP of Commercial Lending at Clark County Credit Union. Chris started his banking career almost 40 years ago as a high school intern. He graduated from UNLV with a degree in financial services and later graduated from Pacific Coast Banker School through the University of Washington. He's held various roles, including Chief Lending Officer, Commercial Loan Manager, Commercial Loan Officer, and Branch Manager. He currently works with the business members at Clark County Credit Union and helps them get the lending they need to grow and develop their businesses. He has served on a number of boards, including Treasurer of Green Valley United Methodist Church and Swain's Creek Pines Lot Owners Association. Welcome to the show. That was a tongue twister early in the morning, but it's great to have you. And we appreciate you spending, the next 20 or 30 minutes with us, diving into all things commercial lending. And you've been in the lending business for a long time. It sounds like once you did your internship, you were hooked on the business. And why don't you give us a little bit more in-depth background about your progression in the business, and then how you ended up at Clark County Credit Union. And we also talk about the difference between regional banks, community banks, credit unions, the large FDIC banks and all that stuff. And I think our viewers and listeners, it would be interesting to understand really the kind of like, what is a credit union, the advantages of, opening an account, whether it's a personal or a business account with a credit union. Personally, I have some credit union bank accounts, and I really like it feels like it's more of a personal relationship like it was in the olden days. And I still think that's why credit unions are doing very well now. But anyways, welcome.
Thank you. I appreciate being on the show today. My history, I have been in the financial services industry for 40 years. First started out as an intern in high school. That was more on the operational side, teller line, bookkeeping, proof department, things of that sort. Moved here to Las Vegas in 1987. I started UNLV in 1989. I was going to school at night while I was working at an organization. Received my degree in 1998. So been doing this for a while now. Lending side, I've started in lending probably in about 1990 from the operational side. So various different positions, like you said, commercial lending officer, chief credit officer, things of that sort. So been with the credit union for about 3 years now, a little over 3 years. I had an opportunity to move over. I wasn't sure if I wanted to leave the banking world and come to the credit union world because there's a little bit of antagonism between the two organizations there. But decided that it was a good move for me at this point. Came over to Clark County, and I've been happy ever since. Loved the move and have been with them, like I said, a little over 3 years. Difference between the credit union and the banking world is, especially with Clark County, we're a nonprofit. So when you open an account with us, open a loan with us, you actually become a member, an owner in the organization. So every year we pay what's called a bonus dividend. We just paid it a couple of weeks back. We paid $2.4 million worth of dividends back to our members. So whether you had a $100 checking account or a $10 million loan, you received a dividend a couple weeks back, a pro rata share of that $2.4 million. I have some of our business members that actually have received dividend payments that equates to basically 1 month's worth of their loan payment with me. So, the effective rate on the loan can drop anywhere from 10 to 15 basis points on whatever I'm charging on a loan by the time you take that bonus dividend into place. So credit unions are a little more personable. We tend to try to get to know the members a lot better, and our goal is to help them with their financial goals, whether it's on the business side or the retail side. So it does give us the ability to spend a little more time with the members. So
Very good. Now let's kind of dive into the lending side. Before we started airing the show, we know that you guys really specialize. One of the things you specialize in is the SBA 504, which we do talk about on the show often. And the SBA 504 is a very useful tool for owner-occupied business owners that are going to occupy the property. And what kind of deals are you seeing the most lately for these 504s? Like what kind of owner operators, some of the recent deals you've looked at?
We've looked at a couple of manufacturing companies, and it was kind of ponied up with the purchase of a business. We've had a couple people buying the business and the real estate where the business is located. So we'll do a 504 on the real estate, and then we'll do just a normal conventional loan on the purchase of the business. So we've seen a number of manufacturers. Right now, we're seeing a number of people that are in the 7A program that want to refinance into the 504 program, because the 504 is a fixed rate for a longer period of time. Typically with the 7A, it has a variable component in it where the rate might adjust either annually or every 5 years, or however the loan is structured. So we've got a number of people looking right now that we're working on as far as refinances of the 7A loan that they're in. And, they've been in the 7A program for a number of years, so the prepayment is next to nothing, and it's beneficial for them to move over to the 504 program as a fixed rate. So
on your 504s, will you guys look at doing construction as well, like a ground up project? Or are you strictly lending on existing value add type of properties?
We are not afraid of the construction industry. We've got a number of construction loans, either 504 or on the conventional side at this point. It is getting difficult on the construction side for the members, the clients, just for the fact of construction costs are a moving target right now. The contractors that are doing the ground up are having difficult time quoting bids. So consequently, it is a little difficult on that side. So you got to build in contingencies and make sure there's enough monies at the end of the project in case there's cost overruns and delays. So, but we will do. We've got a couple of very large 504 loans that aren't ground up construction, but the tenant improvement portion of the building equates to $1 million, $1.5 million just to get the tenant improvements done. So we're not afraid of construction at this point. So,
and so Clark County Credit Union, you're just in Clark County, then that's where you guys focus?
We have branches in Clark County, but based upon our bylaws, I can do loans anywhere in Nevada and then 3 southern counties in Utah, because we've got a couple of business members that have real estate up in Utah. So that's part of our bylaws too. But we can do loans in Reno and anywhere within Nevada, but we only have branches in Las Vegas.
Got it. That's good to know. Hi, this is Beau, host of the Investor Financing Podcast. I appreciate you checking out our channel. On this podcast, we talk about real estate, investing, financing, business lending, and acquiring and expanding your business. I'm sure you will find some videos here that will help you build your business empire. There's a lot to see. Take your time and make sure you comment, like, and subscribe. Thanks again. Let's kind of go back to, this was kind of interesting. So on a 504 transaction, if you're buying a business with it, there's what's called blue sky, right? Like the intangibles. And on a 504, you can't finance that portion with a 504. That's why somebody might do a 7A because they can finance the intangibles, also the real estate. That'd be like one advantage of a 7A. Will you allow in your structure? So it sounds like you're okay doing a 504 on the real estate and then doing a conventional piece on the business takeout, or you would allow for potentially another SBA 7A as a companion on a transaction?
Yeah, we've done a couple of transactions where the real estate portion will fund as a 504. And then, yes, we'll do a conventional loan on the actual purchase and the intangibles, the goodwill of the company, things of that sort. So we've got a couple of transactions on the books like that.
And so will you lend on conventionally on like a somebody that's buying a franchise? Is that something? It's a startup though, and we're not talking about SBA 7A, but would the credit union look at a franchise purchase if it was like just the business, not real estate, or is that not really in your wheelhouse?
Yeah, no, we actually have a client we just closed a month ago who purchased 3 Capriottis. Now he does have experience in that within that franchise, which was what made us really comfortable with the deal. He's got a couple of Capriottis right now. We've got another one that is looking at a Jamba Juice type entity that we're looking at financing for him. So we're not afraid of franchises. I know you've got to, on the SBA side, you've got to be part of their franchise list, but we don't have that problem. So
that's good to know. So that's great. And so you can do some unique things. Now, as far as the commercial side, with your credit union, will you guys do like portfolios of rental properties that are, strictly rental? Will you like finance? If somebody had 10 rental properties in Las Vegas and they want one portfolio loan on that, is that something you guys would entertain, or not really in your wheelhouse?
It's something we will entertain. But the problem is we really got to know the member and the client. I've got a couple of loans like that on the books right now where we've got anywhere from 10 to 15 real estate residential properties under one loan. And the other aspect is last year we had a number of people out of California trying to move into Las Vegas and do exactly that, buy portfolios. And one of the aspects that we've got is if you are not a local individual as far as managing those properties, then you really need to have a local company that manages them. So consequently, we want to know that there's somebody here in Vegas actually, able to manage the properties and keep the properties clean and maintenance done on them, things of that sort. But we're not afraid of doing portfolios, yes.
Because essentially, if you're a business owner, you need to open an account and be a member of the credit union to get your loan. So some credit unions I know have certain restrictions, like you have to be, some of them you have to work for a certain entity. What are the basic high level overviews? I actually live in Henderson, so I live in Clark County. So I'm assuming I could join your credit union as a business or a personal account because I live in.
There's a couple of different aspects, and they're called SEGs as far as how a credit union receives its members and approves its members. Clark County Credit Union started out as a public credit union, and what do I mean by that? The public employees of Clark County, the city of Las Vegas, city of Henderson, things of that sort. So public employees is how we initially started out. We also do the medical field is an SEG. Another one that we have is we have a relationship with the Henderson Chamber of Commerce. If your business is part of the Henderson Chamber of Commerce, that's one of our SEGs. Or if you work for a business that is part of the Henderson Chamber of Commerce, you as an individual can join the credit union too. Now, the one kicker that we have is NPR, Nevada Public Radio. If you make a donation to NPR typically we help fund that too, then we can open an account for you as a member of the credit union. So that's really the way on the business side that we're able to basically help any business, because if they aren't in one of our SEGs, then we look at it through the NPR aspect.
Great. I'm a member of the chamber, one of my businesses, so I could join. So good. I qualify. All right. That's good to know. Now, so you do conventional loans, you look at construction deals. What other lending products do you say you look at the most frequently right now?
Yeah, most frequently right now, we were doing a lot of construction. That's kind of backed off a little bit here recently with, like I said, the costs of materials, but we do have a lot of construction loans on the books right now for investor property and owner occupied. So consequently, we will do either way. You don't have to just be an owner occupied. We do have a number of equipment loans. Some of our members, our personal members, with COVID, they moved off and started like trucking companies. So they wanted to finance tractor trailers, things of that sort. So we've got a number of those on the books at this point too. But like I said, bread and butter is really real estate. We do a lot of it. I'm hoping to kind of diversify into more commercial, industrial, the equipment and lines of credit over the next year. But right now it's a lot of real estate.
Okay, cool. That's great. Now, can we talk about, and we could generalize about credit unions and small regional banks, but I think this will help a lot of the people listening and watching right now, or in the future when they watch this. I think that there's huge power in local lenders, right? That a lot of people, when they're shopping for a loan, they might call like the large, banks of the world. But what I see in the lending space, because I've been in the lending space for 23 years, is that a lot of these smaller lending institutions, because of relationships, oftentimes they'll do stuff a little bit outside the box. They'll hire leverage sometimes because they have a personal relationship. They have the business bank accounts, they have the personal bank accounts, they can see the cash flow of the sponsor or borrower. But how does the process work as far as credit committees? And I know every institution is a little bit different, but let's just say I came in and I was looking to build something, a business, and it was going to be a 504 deal. So we know we need to get a CDC involved at some point. But what does the conversation look like? How can I be prepared as a borrower to put myself in the best light possible? Because we know there's certain documents, obviously for SBA, that we need to complete. But can you kind of like, over your 40 years of banking experience, give some insight of how you would, if you're newer and you haven't done 20 loans in your life, how to approach a commercial banker, and what the process would look like, and how do you put yourself in the best light possible to have that kind of conversation? Like, here's the high level of what I want to do. Is this feasible? What kind of leverage could I expect? What are you going to look at on my financials? How would you best kind of express that to somebody who might not have done a ton of loans in their life as a borrower?
And let me start off by talking a little bit about, the smaller organizations like you talked about. They tend to be a little more flexible than the larger national financial institutions. So a smaller institution like a credit union like us, we don't necessarily have a box. I'll look at stuff all day long that I end up not being able to do, but at least I can give advice to the individual and say, you really need to do X, Y, and Z in order to help your cause and help you get financing on this project, things of that sort. So it's a little more flexible with a small organization. In my case, I have one individual that I have to go to for loans up to $1 million, and anything over $1 million goes to my loan committee. Loan committee meets once a week. My lending limit is 12 million. And I have done deals over 12 million with participations from other organizations that I know of. So we recently, probably about 45 days ago, closed a construction ground up for a hotel that's about $18 million. So we took 10. I participated 8 million to another organization. So we can do larger deals. It's not just small deals. So now for the members, the clients, what the biggest thing that I see is be prepared. I'll have people call me up and say, yeah, I want to buy this business and I'm going to improve the cash flow of it. Well, how? Why? What are you going to do? What's the business plan? Things of that sort. And so being prepared, having, do some research as far as why you think you can increase the cash flows. Or if you're building a building and you're looking at an investor type property, why do you think your property is going to be a better draw than the property right across the street that has vacancies right now? So, you got to be prepared. You got to have a little bit of research under your belt as far as why you believe that your project is going to work, and have numbers. Use resources. Go to your CPA and say, okay, these are my projections. Do they look right based upon other types industries like this? Because a CPA has a wide range of people that they have as clients. So odds are that whoever your CPA is, they have a similar type business that they've looked at the financials for. So they can be a crucial part of you being able to get your financials in shape and projections put into shape. So but that's probably the biggest aspect that we see a lot is people that just aren't prepared. They think that they can just walk into a financial institution and they're going to get the loan for with really no research being done and no reason on why they think they're going to be profitable and successful. So
yeah, I see that a lot. And it's hard if you're not used to doing this. There's actually third-party companies that will help you put together the business plan, the projection, especially for SBA. Like I have a lady I was speaking with, and she's got a startup idea to build soccer arenas, and she's going to charge people to play soccer, the sport leagues and stuff. It's a great idea. It's just, diving into the weeds of trying to figure out, okay, how are we going to charge, by, is it a monthly membership, and really getting that into a business plan with pro forma is so critical. So oftentimes, like, there are people out there, there's companies that actually specialize, that can put together and help you do your business plan, which is huge. And so if you're looking to borrow $1 million and you have to spend $2,000 or something like that to get a really good business plan done, I think it's in your best interest to do, because at the end of the day, you want to put your loan request in the best light possible. And you can tell when somebody's prepared and when somebody's not prepared. And I think that's what I heard you saying, that, and it's okay to have an initial conversation, but know that you're probably not going to get your loan request approved if people don't understand exactly what all the mechanics of the loan are. Yeah. And so yeah, I see that a lot. And I see a lot of people have kind of misconceptions of SBA and what it can do and what it can't do. And they don't get why can I do self-storage, but I can't do a multifamily property? Because it's owner user. They don't, since 2010, they allow for self-storage. And people don't kind of get that concept that it's really meant for an owner operator type of business. And SBA is designed to help small businesses. And so I get a lot of calls about that. Like, they think they can use SBA for multifamily, but that's good that you'll look at hospitality, because that's a very challenging asset class to finance. Now, we're seeing a lot of like motel type of properties, like in like the Lake Tahoe area, for example. And they're kind of the older property types. And maybe they're being run as like an extended stay right now. And now an operator is buying the property and they want to kind of make it into a boutique motel and then kind of use Airbnb as a tool. I'm seeing a lot of that where, but the problem with that is that you need to show experience with SBA in that, especially with hospitality, right? I mean, that's a big thing. So, yeah, I don't know what kind of advice you have, and are those feasible to get done? Or is it more likely to get done as a 7A versus a 504? Because 7A might be a little bit more liberal on what they can and can't do.
They are feasible, and you're right. It's based upon your experience and your knowledge. That $18 million ground up hotel that I mentioned earlier, the owners, our borrowers, had no experience in that industry whatsoever. Well, that property is flagged by Marriott. Marriott has a third-party entity that will manage hotels for them. So consequently, you know, our borrower brought this third-party company in as the management entity, which made us feel tremendously comfortable, because this third-party company has hundreds of properties all over the country that they manage. So their experience is in depth, and they've got a lot of knowledge in Marriott flagship. So on the motel side, yeah, is it a flagged entity? Is it not? If it's not, then how are you going to compete with a flagged entity? And what does your management look like? Who is managing it day to day for you? And yes, it is difficult if you don't have any experience to get a loan put into place for somebody that has zero experience managing a motel, and they're thinking they're just going to be able to go on to Airbnb and kill it. So there's a lot more, and I see this not necessarily just with motel purchases, but also with any type of business. There are people that are geared towards the sales side. As long as I'm getting sales, I'm growing my sales number, I'm going to be good, and everything's going to be great. Well, if you're letting your expense side on the backside, you know, you've got somebody, you know, that's managing it incorrectly, and your expenses are 10% higher than what they should be, you're losing money on the backside if you're not watching that. And that's where management comes in. In our organization, like I said, we are a little more flexible. We'll talk to people. I'll give people advice if they don't have a manager put into place, you know, how they can try to find somebody to help them out and manage the day-to-day and things of that sort. But the 504, this $18 million deal is a straight conventional deal.
So it wasn't SB. You didn't do SB on that. It's just straight conventional.
Nope, that's a straight conventional deal that we've got on the books.
Yeah, I'll have to talk to you offline. I got one for you, similar to that, and the sponsor's got experience and so forth. So it's good that I know you do that. It's right here in town, so would love to introduce you to. And he's got experience. He's got the financial wherewithal, but I think it's like close to $30 million deal. But it's shovel ready. He's looking for a lender. But yeah, so anyways, that's great that you guys will entertain hospitality, because many lenders, you know, during COVID got kind of scared of it. But it seems like even that things are still moving. Things are changing a little bit, obviously, because people are working from home and so forth. So it'll be an interesting year as rates may go up, and see how that affects the real estate world. And kind of going back to the credit union, if you're a business owner, maybe just, and I'm not even talking about lending per se as far as real estate lending, but it seems that credit unions are fairly good to open business accounts too, because you can is there some advantages that to get business credit cards and so forth? Do the credit unions all work with certain providers on like the credit card and business lines of credit aspect of it?
Well, the lines of credit, we will do those internally. We don't work with anybody outside. The credit union or the credit card side, we actually underwrite ourselves and portfolio ourselves. There's a number of smaller institutions that will work with a third party that does all the portfolioing of their credit cards and all the documentation and underwriting. But we do all that internally because we obviously have that aspect on the personal side. So we do credit cards internally for businesses. Typically, we like to see that the business is up and operational. Startups are difficult, whether it's credit cards or any kind of financing whatsoever. For most financial institutions, startups are a little difficult to finance, but that's the aspect of being a little more flexible and being able to spend some time with the people and talk to them and give them options. So,
and on these construction deals, let's just use this $18 million. What was that LTC, the loan to cost? Is it a 65 or 70% LTC? Are you going higher leverage or?
yeah, that one ended up being 65%, I believe, because the borrower actually owned the land outright at that point. They had bought it as part of a larger development, and they developed everything on the front pad of it. They had front pads as retail, so they had this back parcel that was free and clear. And they also were putting in cash. So yeah, that one was, I believe, a 65% loan to cost on that one. Typically, again, with the materials for construction right now and being a moving target, the leverage on something like that, we try to keep as low as possible just to give us, if we have a problem down the road, it gives us the ability to do another loan for change orders or cost overruns as a second deed of trust down the road. So
you do have that flexibility too, that you work with borrowers. What about do you have a portfolio of multifamily where you lend on multifamily assets, 10, 20, 100 unit properties?
I typically like to keep the sweet spot for us within the multifamily somewhere around 30 to 50 units. I don't try to compete with the big boys and the REITs and the insurance companies that'll do 100, 300 units, things of that sort, because I don't try to compete on the non-recourse that they might do, or even the interest rates. So my sweet spot is somewhere around 30 to 50 units. But we do have a number of those. We financed a couple of those last year, probably about 20 to 30 units. And we did a number of those. So
would you do, if it was a value add multifamily deal, would you actually do a construction holdback? And okay.
Yeah, we've got one right now on the books that was 25 units, I believe. And they came in and part of the financing was to come in and revamp the entire property. They completely remodel each unit. So yeah, we're in the middle of that one right now. Very
good. And last question, because I know time always goes fast here. On your SBA 504 deals, the senior debt credit unions piece, right? Because after debenture, the CDC is going to acquire that, and the debenture is going to happen. But you'll fund the senior and junior piece during construction. You'll portfolio that, okay. And then, are you on your senior debt? Are you usually a 5-year fixed, amortized over 25, or amortized over 30? Will you do like a longer fixed rate period? What's usually the way you guys kind of look at that?
Yeah, the typical loan that we look at has a 25-year amortization, which is our max that I can go. We have done shorter amortizations mainly because the clients asked for it. So, but a 25-year amortization, we'll do a 10-year maturity with a 5-year fixed. We use the index of prime lending rate. So typically it's prime 1.25 to maybe 1.5, somewhere in that range. So we're at 4.5 to 4.75, maybe 5%. Now, construction, I usually charge a little bit more because obviously there's a lot more work in construction and documentation. So I do have a few loans on the books where I'll charge during the construction portion, it might be 5 or even 5.25% interest rate. But once it rolls to perm, we'll roll it at a lower, more market rate of, 4.5, 4.75, something.
And what about, I don't know if it's appropriate to get into it, but is there any advantages as far as, I mean, the rates are great, but as far as like origination fees, lender costs, is there any, the difference is, I mean, is it always case by case on these type of deals?
Yeah, it'll depend on case by case. If somebody walks in the door and they're looking at a refinance on a piece of property they already own, and they're at a 40% loan to value or 30% loan to value, and the guarantor is extremely strong, doesn't have a lot of contingent liability, good liquidity, things of that sort. Yeah, we can play with the numbers as far as the origination fees and interest rates and things of that sort. So we look at them case by case.
Very good. Well, Chris, this has been very useful for us. And if anybody's in Nevada and needs a loan, I think you know where to go for SBA or commercial lending. It sounds like if you can join as a member, there's many benefits as well to open a credit union business or personal account. So we really appreciate your time and hope to have you back on the show and dive deeper into the structure of the SBA 504, because people get a little confused on the different, how it all works. But it is a very, very useful tool. I would say that it's probably going to be another booming year for SBA 7As and 504s. The lenders like to do them because it's low leverage after the debenture, right? You're 45, 50% loan to value. So the lenders like it, the borrowers like it because they get a fixed rate on their junior lien it's a 25-year straight fixed loan. Right now, I think the rate's about 3.27 or something. It fluctuates monthly, but the rates are really good on that still. They were in the mid to upper twos, the lowest I saw them about 6 months ago, but rates are going to climb. I know when the SBA refinance program was just enabled like maybe a year ago, which that's why you're seeing people doing SBA 7A refinances into 504, because you're taking the SBA 7A loan, just if you're listening, and is usually a variable rate, Wall Street Journal plus the margin, right? And so those rates are probably in the 6s. And so that's why a lot of people are looking to refinance into a 504, and they can re-amortize a loan. So stretch out the loan. So payments are less off the bat, plus the rate goes down. So you can do a substantial savings by doing that. And that's why I think a lot of people are looking to refinance right now. And I think if I had a 7A right now, I would be doing the same thing. The 504 can only fund the tangible items like the heavy equipment or the inventory or the real estate. And it's a lot of times you do rent replacements, right? So it's a doctor, lawyer, dentist, they've been renting for 20 years and they're going, why? I should just own the building. I get the additional write-offs potentially, and then I get appreciation and depreciation. So that's why people are looking at these doctors, attorneys, and professional business owners that they should maybe buy a building and use SBA. It's a great tool for that. So
yeah, on the 504 side, I've actually showed people, especially with the interest rate on that second deed of trust by the SBA, where the payments on the two loans are less than the rent they're paying at this point in time. So it's a very beneficial tool and product for like you said, a doctor that might want to buy the building instead of rent it. So
Yeah, well, really appreciate your time. This was very insightful. I'm sure everybody that's going to watch us in the future is going to get a lot of value out of it. So thank you so much. And everybody, please like, subscribe to the channel. We appreciate you watching, everybody. And please share with your colleagues. And thanks. And we'll see you on the next episode.
thank you.